Morning, everyone. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, July 12th. Our note this week was titled Command and Control. It was released on Saturday, July 10th. This is our verbal summary of that note, and will also be our video produced by Nucleus 195. Again, a reminder that these verbal summaries are going to go behind the subscriber paywall later this summer. So please consider becoming a subscriber. If you need a trial to have a look at all of our material, then send us an email. We'd be happy to do that for you. So there were 4 sections to our note this week. The first section was titled A Global Not U.S. Growth Scare. The second section was Command and Control with Chinese Characteristics. The third section was Earnings, Watch Financials and Industrials. And then the fourth section was a policy update. There were a number of important policy developments last week. So first, on the global not U.S. growth rate scare, we thought we'd go back a little bit with the ferocious rally we had in rates last week and remind our readers about the summer of 2019 when we had a similarly ferocious rally in Treasury prices, yields falling sharply, and the yield curves inverted, including the so-called recession curve, which is the 3-month, 10-year yield curve that so much academic research has been done around to conclude that is a good forecasting mechanism for recessions. And at the time, we were adamant that what that curve was telling us was that the global manufacturing and trade industries were already in recession, but that this did not portend a recession for the US. This is largely because the role of the dollar in global trade has increased significantly since the global financial crisis. Some 80% of trade credit is conducted in US dollars. That was not true prior to the global financial crisis. And the dollar has become the dominant safe haven asset for, for collateralization, even in things like derivatives, but throughout financial markets. And so that role of treasuries is crucial. So at a point where, people thought China was tightening, and it turns out that their growth was slowing, and we're going to come back and talk about China in a minute, and China, in fact, needed to ease. Global trade is undoubtedly peaking, notwithstanding the bottlenecks that it'll take some time to clear. This is really all about global growth slowing, not getting their populations vaccinated, the variants starting to create a dynamic where there were our main trading partners are even more dependent upon exports, and U.S. trade deficit has gone to an absolute record level, and that's just created more and more demand for treasuries. So this is why we had the ferocious rally. We remain convinced that we'll get our 6th consecutive summer low in treasury yields, and we will have a sharp move higher in treasury yields through the course of the second half of the year. So, if you go back in time and go through that progression, we've got a chart we can show you of nominal GDP and yields. And that what that chart shows you is up until about the conundrum period in 2004 through 2006, when global trade growth, China's market share was just rising exponentially. Nominal GDP generally tended to be below treasury yields. At that point, treasury yields went below nominal GDP, and they've stayed there ever since. This is, again, an illustration of the point we were just making about the role of the dollar. Back in that period, the Japanese were intervening aggressively in their currency. Chinese had a fixed exchange rate until 2005, and then a crawling peg from that point. And all those factors pushed treasury yields below nominal GDP. In the 2010s, the role of the Fed continued to push those yields down relative to nominal GDP. And so when we hear things like we did last week, that the Treasury yield is telling you growth is slowing in the US. This is sort of a long-winded way of saying that's not it at all. We have no concerns about the growth outlook in the US. Sure, earnings growth is peaking. Sure, GDP is peaking on a year-on-year basis, but it's likely to remain quite robust from this point forward. So this is not about US growth. This is about global growth. And we don't think it's going to persist anyway. So moving on to the next section of the note called Command and Control with Chinese Characteristics. We wanted to start by reading you a Friedrich Hayek quote from his Nobel Prize lecture in 1974 that we think is pretty apt for the current situation in China. And it goes like this: if man is not to do more harm than good in his efforts to improve the social order, he will have to learn that in this, as in all other fields where essential complexity of an organized kind prevails, he cannot acquire the full knowledge which would make mastery of the events possible. He will therefore have to use what knowledge he can achieve, not to shape the results as a craftsman shapes his handiwork, but rather to cultivate a growth by providing the appropriate environment in the manner in which the gardener does this for his plants. There is danger in the exuberant feeling of ever-growing power which the advance of the physical sciences has engendered, and which tempts man to try, dizzy with success, to use a characteristic phrase of early communism, to subject not only to our natural but also our human environment to the control of a human will. The recognition of the insuperable limits to his knowledge ought to indeed to teach the student of society a lesson of humility which should guard him against becoming an accomplice in men's fatal striving to control society, a striving which makes him not only a tyrant over his fellows, but which may well make him the destroyer of a civilization which no brain has designed, but which has grown from the free efforts of millions of individuals. I just thought that was incredibly apt for the current situation in China, where, as a consequence of the pandemic, the level of control over the economy has gone up, not down. And you could see the results. Production has been much stronger than consumption. Exports have been much stronger than imports. State-owned enterprise investment has been much stronger than private sector investment. And any signs of dynamism in the Chinese economy, the tech sector, Hong Kong, have been squished. And so this is very much what Hayek was talking about. We see it at work right now. And you can see in our scatter plot that we're going to show you of total factor productivity, which is a proxy for technology innovation against per capita GDP, that the US sits in the far right corner and the Chinese sit in the far lower left corner. This is really a proxy for human welfare and societal benefit. So we are absolutely convinced. We were quite bearish on China prior to the pandemic, and we think the pandemic just accelerated, much of the way it accelerated positive productivity trends. In the US, it accelerated negative productivity trends. In China, we would not be long Chinese equities. We would not be investing in Chinese assets. So moving on to earnings season, which gets going this week, as you all know, tomorrow. We want to focus your attention in particular on financials and industrials. Now, if you go through last quarter's earnings season, first of all, we're expecting 65% year-on-year earnings growth this quarter, 18% revenue growth. We tend to look at revenue growth a little more closely. Last quarter, we wound up with 50% earnings growth and 11% revenue growth. The surprise relative to expectations was 23% on earnings and 4% on revenues. But the average stock reaction to those earnings was a 20 basis point decline. The S&P did grind up through earnings season, through the 3-week period by about 1.5%, and then consolidated afterward. We've been grinding into this quarter's earnings season. It may very well grind a little bit higher through it as well before we get to what likely we don't expect to be a consolidation, but to be a sell-off prompted by the Fed starting to taper their large-scale asset purchases. But the two sectors that did react favorably to earnings last season were financials, which rose 50 basis points on average, and industrials, which rose 30 basis points on average. Now, two of the main macro factors that are going to come back or make a real evident return this quarter are going to be buybacks and capital investment. Earnings have recovered. You expect to see that. Financials are the poster child for more buybacks. If you're tempted to sell your financial stock after good earnings, remember, you're probably going to be selling it to the company. And then on CapEx, we think that'll be increasingly evident across sectors. And that's in particular good news for the industrial sector. They still have an earnings gap. There's a lot of upside in earnings, revenues, margins, and underlying CapEx for the industrial sector. So those are the two to watch. We wrapped up the note this week with a bit of a policy update. We included some of the Fed inflation language, which still there are members of the Fed that think this is all transitory. We obviously don't. We think that global supply chains are going to be restructured, and we will not see a return to global goods disinflation as we have for the last couple of decades. But then we wanted to discuss antitrust policy. We haven't written about this, though we did start writing. We haven't written about it recently. We did start writing about it last summer, about the rise of structuralism or new Brandianism, this idea that big is bad and that large vertically integrated companies, even without evidence of price gouging, should be broken up. And there was a very significant procedural change in the FTC after Biden's unconventional nomination of Lina Khan to be a member of the FTC, but not telling Congress he was going to make her the head commissioner, lead commissioner, which he subsequently did. There was then a procedural change which allows any of the 5 commissioners to bring actions, administrative actions against any company. So this is going to be a very active FTC, and it's going to be a problem for these big cap tech stocks over time, even if you believe that ultimately breaking them up would be good news. In the meantime, this could be a problem for these stocks as we go through this process, which is only going to accelerate as we get into the second half of the year. And then a couple of comments on the Biden competitiveness executive order. There's a lot of big government stuff in there, but 2 things in particular could contribute positively to labor market dynamism, which is a big focus of ours. First, when Stephen Davis and Halterwanger originally wrote their paper about labor market fluidity, one of the things they cited for a much less dynamic labor market over the last few decades has been occupational licenses. By some measures, those went from 5% of occupations back in the 60s to nearly 40% today. Not sure what the Biden administration can do from the federal level to mitigate that problem. A lot of it is at the state and local level, but occupational licenses are a mess and are a barrier to more dynamic labor markets. And then non-competes, we would agree with their objective on that as well, although you could go too far. But nonetheless, these would be positives for labor market dynamism. So that's it for us this week. We one final comment on policy that I just about neglected, which is we're going to see the discussion about the infrastructure plan and the American Families Plan starts to heat up. There's a very short window for Congress for the balance of the summer. The Senate's coming back from recess this week. So that has been a major driver of the back end of the bond market. And again, is one of our reasons for being bearish on treasuries for the second half of the year, is this idea that we're going to have more deficit finance spending from Congress. So we'll hear more about that in the next week or 2. That's it for me this week. Barry Knapp, Ironsides Macro. Please consider becoming a paid subscriber. These verbal summaries are going to go behind the paywall towards the end of the summer. Thanks very much. Have a good week.